What happens to the 10-year yield next?
Well, I think you need to look at the data and whether you can actually justify further increases in yields on the basis of the data. And in a sense, if you actually looked at yesterday's move and say, well, did the retail sales report in itself really justify such an explosion in yields? And I'm not sure necessarily it did. Yes, it implied that perhaps activity was a little firmer than we'd assumed in Q1, but it doesn't necessarily materially turn the dial. And I don't think we're in a scenario where the market should be thinking the Federal Reserve is very much behind the curve, either in inflation or in terms of its policy direction. So I think that it does beg the question as to what would be the catalyst to really extend the move, and I'm not sure that we're going to see sufficiently strong data in order to justify that.
Okay, so first of all, let's look at that move, and also thank you so much for all of you viewers out there and listeners on Bloomberg Radio sending us your questions. I have a great question here, which is basically, I want to know today, don't we all, what the 10-year will do. Will it rise further? Now, first of all, let me bring you over to my chart. Now, this is, so that's the question, which I was going to ask myself, but please keep on those questions coming. And then you can just see the 10-year rate, you can see 1% higher than global yields. Peter, what do you think it will take for this to go further?
Well, I'm not sure that you can really justify yields at current levels, given where we've been, in a sense. Obviously, the Federal Reserve has held the short end of the curve down for an awful long time, but it's beginning to take away that support. Don't forget also that the Fed is winding down its balance sheet. So I do think that yields are set to go moderately higher, but it is a grind. It's a grindingly slow process. If you said to me 3.25% by the end of the year, I wouldn't overly disagree with you. I think the range is sort of 2.9 to 3.25 or thereabouts over the course of the next 6 months.
OK, and what happens after that?
Well, after that, I mean, I think that you're probably going to more or less top out, because a lot will then depend, I think, increasingly on A, what the Fed does, how quickly it runs down the balance sheet, and B, what the economy does. I mean, let's not forget that we're already we're already experiencing the second longest upswing in recorded history in the United States. Can the economy maintain its current momentum? The likelihood is it probably can for some time to come, but that is going to be, I think, the decisive factor for most bond investors.
You agree with that?
Yeah, absolutely. I think in the context of the growth cycle, we've seen a little bit of growth perhaps brought forward from 2019 into 2018 in terms of the fiscal changes. The question is whether the consumer can maintain the degree of expenditure into 2019, or whether we are going to see a natural deceleration. And I think, I'd agree entirely in terms of the, sort of the length of the economic cycle does suggest that we are likely to see a moderation into 2019. And if we are going to get the Federal Reserve putting in probably another 2 hikes this year, maybe another 3 next year, that is probably going to be a sort of a scenario which gets us above neutral and probably will encourage markets to consider that that is the end of the cycle unless we start to see inflationary pressures build well beyond the sort of assumptions that we have at the moment.